The markets are open and we are seeing some mixed results across the board, although notably Nvidia is up now more than 2%. However, when we do look over the last few weeks, the industry as a whole has been hit, the majority in the red. Now today we want to focus on Nvidia. Is it undervalued? What price targets do we have? And should we consider adding more to the portfolio? We just need to look at the analysts who seem to be continually very bullish on this company. They believe just in 2025 alone, this company is going to increase around 70%. We have Wall Street who believe this market cap will hit 10 trillion, which is a very strong indication that not only are they buying, but they believe the upside has not even started yet for a company. When we do take a look at it, just over the last year is up 187%. Now, as we've established, the semiconductor industry over the last few days, as well as the last month, has been hit, although Nvidia is only down around 1%, meaning that whilst there has been volatility across the market, Nvidia, the leader, does look to be strong, both on a year-to-date perspective, as well as the last 12 months. And over the last 10 years, if you had invested in this company, you would be up more than 26,000%. In fact, you would be laughing all the way to the bank. Now, it does currently sit towards the upper end of the 52-week range. In fact, the all-time high sits at $153. And we notice Wall Street do give this a strong buy, something they have stood by for quite some time, and both Seeking Alpha and Quant, while you do see that hold rating, 3.5 would turn this into a buy. They're both not very far from it at all, so you could argue right now, whilst we do have a hold from them both, they are sitting on the fence. Now, in terms of the yield, we will just mention it. It pays out at 0.03%, probably not something you do consider with this company, and the forward P sits at just below 46. Now, we'll talk about that in a little bit more detail with their earnings expectations coming up, but when we just remind you of how their earnings from Q3 was for FY25, well, they've nearly doubled their revenue on what they can see as strong AI demand that is keeping pace with the market's expectations, which is a good sign given that the valuation is very costly at a first glance, and we can see, no surprises, they did beat on both their top line revenue as well as their EPS. Now, in terms of how well they did, well, 81 cents was what they reported, above the market expectations of 75, and their revenue also came in much higher. We're talking 10%, 33.16 is what they wanted, 35.08 is what Nvidia delivered. Now, for the next quarter, they're expecting around 37.5 billion, and that is marginally higher than what Wall Street were anticipating, around 37.08. So nice to see continued growth even with the rapid rise they have had. But one thing we do want to point out, where Wall Street are getting a little bit worried, you might argue no cause for concern, but the increase is 94% from the same quarter last year. When we look at the previous 3 quarters, as noted here, they are up quite significantly. So one of their concerns with the share price that has gone up astronomical over the last 10 years, that maybe we are starting to see a slowdown in the numbers. Now, you would be right in thinking that they believe this company will continue to increase as we just saw in 2025 and in fact over the next year with that market cap to 10 trillion. But this is where Wall Street are a little bit hesitant. And we can show you, if you want to see where the growth is coming from, primarily the data center, where they reported 30.8 billion just in this quarter. When you look at the same quarter last year at 14.5, they have effectively more than doubled just from that one income stream. Now, we do notice growth in the gaming as well as the professional visualization, and in fact in both the auto and OEM. So growth is coming, but mainly the analysts are looking at the data center, where they do believe we will see this continuation of very rapid increases. Now, we'll take a look. They have just released their investor presentation, which did take a few more days to come out after they reported their earnings, and a few things that we do want to highlight in today's episode. The first one is their top line revenue growth. When we look at the more recent period, has grown at an astronomical rate. FY23 more than doubled into FY24, and as we can see, this is year to date FY25. We are still waiting for Q4 for this to end up being the full year, but right now what we are noticing is there's a 50% increase from the full year. When we get the essential extra quarter, we will be expecting a near double from the previous year. On top of that, what we love to see in companies, high quality, we always talk about that as 2 criteria. An increase to their top line revenue, something we have noticed for Nvidia, but also an increase to their margins, and we get to see their operating margin was 34% in FY20, FY24 61%, and so far year to date 67%. Now there's a phenomenal feat. Their margins are growing as fast as their top line revenue. Definitely something we do find incredibly attractive about this company, and we are starting to buy into the picture that this could be a very strong contender for one of the best companies in your portfolio over the longer term. In terms of free cash flow, this is also something what we want to see. Growth, ultimately, this does drive our valuation model that we will come to towards the end of the episode, but we can see, similar to their top line revenue, their free cash flows are increasing at a very rapid rate. In terms of share repurchases, we will cover this on a historical basis, but ultimately management return excess cash when they do share buybacks. We can see they've utilized around 26 billion of their cash for the first 9 months, and we do believe they will continue this given how much they have remaining authorized as of the end of this quarter. And for those that are interested in the dividend and maybe missed this earlier on in the year, they did increase that by 150%. We also want to highlight where the growth is coming from. We already showed you, but just in a different format here. Data center has really driven this company to be as strong as it is, especially over the last few years. We can see over the last 5, the compounded annual growth rate of their revenue, particular to data centers, has come at 75% year on year. Definitely a very, very impressive feat. Now, what we also like about this company is that they're not just looking at the current time period, they're also looking towards next year, the year after, and even 2027, where they have Blackwell, but also Blackwell Ultra, the GPU, coming out in 2025, and then the subsequent year, we have the Rubin GPU, followed by in 2027, the Rubin Ultra. And we do expect these to perform as well and as strongly as we have seen from the data for 2024, and no surprises, because when we do take a look at what the other Mag 7 companies are talking about, they're increasing their capital expenditure significantly over the shorter term, and that includes buying a lot of products from Nvidia. When we take a look at this company moving forwards, you shouldn't be surprised to see massive double-digit growth anticipated over the next 4 quarters to the earnings per share, and we can also see management do have a 100% track record. Over the last 4 quarters, they have outperformed analyst targets, which should hopefully give you faith that by January 2026, their next 4-year accounts, they will hit their target of 444, ultimately lowering the forward P to 30.63. Now, we'll also highlight some of these metrics for the latest quarter, showing us the strength in this company. Dividend safety, 89, very safe score. We'll talk about this metric, but you may be surprised to see we do get an undervaluation signal, which we will touch upon, and here is just confirmation of the increase we saw in May of 150%. Now, it was reaffirmed a few months ago, their very safe score, and what it ultimately means, a dividend cut is highly unlikely. Definitely no surprises within that metric. In terms of some other metrics, this is how they performed in the 07-09 recession. While no dividend was paid, so no comparative data, we noticed their recession sales was below the average growth, -35, S&P itself -12, and they also trailed the S&P in terms of their performance, -78, with the S&P itself -55. As we said, dividends aren't a major factor of this company and management in terms of their capital allocation, but we did get a triple-digit increase just this year, and that is why we see over the last 5 years, 1% increase year on year, over the last 10, 7%, and there has also been over a few years just keeping that dividend at the same rate, and therefore that is why we don't see any years of consecutive increase. This year, in fact, will be the first, but nonetheless, they have been paying a dividend for the last 11 years without a reduction. Now we move on to the first valuation metric. Now we will cover our own, so we don't take a look at this in isolation, but this tells us the fair price of the company should be within the blue bucket, and we notice right now it has come out, not something that happens too often over the course of the year, and thereby this is a severe undervaluation signal. Remember, we're not concluding on the valuation just yet. We then move on to dividend yield theory. Now, we're not going to use it for Nvidia because we wouldn't call it a typical dividend paying company, but what this would suggest is that a company is undervalued when the current yield sits above the 5-year. What we want to draw your attention to is the forward P, where we do get an undervaluation signal, 35.8, that is below the 5-year rolling of 42.9. So as we said, a undervaluation signal which reinforces what we just saw above. And in terms of the sector P for information technology, it sits at 28.2, thereby meaning Nvidia does currently trade at a premium to the sector. Does it deserve to trade at a premium? The answer is most likely yes. We will show you that when comparing the sector median metrics. The question we need to answer today, though, is what margin of safety should we be paying for this premium company? Now, free cash flow payout, as always, on this channel, will draw your attention to that over the earnings, which is susceptible to manipulation by management through accounting. Below 50% is what we want for the industry. Remember, we have targets because we want management to be able to increase those dividends at a double-digit rate. So these thresholds do give us some consistency within understanding if that is possible. Now, nice to note, it has been decreasing over the last 10 years, 1% this year, 1% anticipated over the next 12 months. So if they really wanted to, they have a lot of cash, as we will show you. They could continue to increase it at a triple-digit rate, or perhaps what they are also doing, a lot of share buybacks. In terms of free cash flow per share, we want consistent increases over the longer term. Now, we don't get that consistency in terms of growth, but what we do see is a very rapid movement from 23 to 24 and expected over the next 12 months to more than triple. That is just testament to the massive growth that this company has, at least in the shorter term. And then when we move to the sales growth, ideally we want to see above the 3 to 4% just to keep up in line with inflation. This company, at least double digit for the majority of the last 10 years. We're seeing triple digit in 2024 and triple digit on a trailing 12-month basis. Then we can see here from a numerical perspective, but we want to draw your attention to the shares outstanding. Now, you will have noticed if you were a shareholder from 2015 to this period right now, they would have diluted your position by around 10%, but ultimately you wouldn't really have cared given the massive growth this company has had, especially outperforming significantly the S&P. But what we are noticing from 2022, they have started to do share buybacks, and something, as we saw from their latest investor presentation, they are keen on continuing at least over the next few quarters. ROIC, our favored metric, 10% or more, 12 for the industry. Give us faith, management are able to effectively allocate their capital, looking very strong on a consistent basis. 61 in 2024, 92 on a trailing 12 month. That is absolutely phenomenal, and investors and potential investors will find that very, very attractive. Now remember, we saw the margins increase. That is a sign of operating efficiency. It was 16% in 2015, 54 in 2024, and consistently above that minimum that we want to target. So great news. Hopefully, if they can, it would be fantastic to continue to increase their margins whilst their revenue expands. Free cash flow margin above the minimums that we want to see, 50% on a trailing 12 month is also fantastic. We then move on to one of the best metrics we like here on this channel alongside the ROIC, the net debt to EBITDA. That references the earnings before the interest, tax, depreciation, amortization. And remember, this metric correlates to dividend safety, balance sheet strength. Below 1.5 is what we want to see, and the numbers below, lack of numbers as well, tell us the number of years it would take the company to pay off all of their debt net of cash on hand. Absolutely fantastic company, not even 1 day to pay off all of their debt, and that is a very strong signal that their balance sheet, as we will come to show you, is absolutely phenomenal. Now, we also want to let you know we have released our latest free weekly article where we run through 2 beaten down stocks with over 30% upside, and we release this every single Monday morning for free to your inbox, where we also cover severely undervalued stocks for your attention and what's gone on in the market over the last few days. Click below, you can sign up and read straight away. You'll also be able to gain a copy of November's stocks, 40 of them which are undervalued. We are releasing December's very shortly as well, where we analyze each one and talk about the upside as well that Wall Street see over the next year. On top of that, you can grab a recently released copy of 29 dividend stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So click below, you can sign up and read straight away. We then continue our analysis with insider ownership, where we see 4.23% with 1 billion worth of sales over the last year. We notice in the more recent quarter, 36 million worth of sales. And while we do show you this information, we do believe that it isn't necessarily a bearish signal. They sell for many reasons, personal and financial. The most recent one, in fact, just a few days ago, we get the director selling around 716 shares, and this netted him around $100,000. Again, information is here if you want to make note, but as we said, not something we consider. Institutional aspect, 66% ownership, 30 billion worth of sales over the last year. During the same time frame, a massive amount more buys, as we can see, 290 billion. But what we find interesting to note, in the more recent quarter, we only get a little bit more buying than selling by the institutions. Definitely something that you can note. However, do remember we never copy what the insiders or institutions do, and we always do our own due diligence before executing on any company. Now we want to just highlight the income statement. We've already talked about their top line revenue, which growth has been absolutely fantastic, especially over the last few years. But we want to draw your attention today to the bottom line net income. Does it give us a similar story? And the answer is pretty much yes. It has been growing over the longer term, but we really see that growth driver just over the last year. In fact, it's gone from January 2023, 4.4 billion to 30 billion in January 2024. And look at that trailing 12 months, 63 billion. Again, we can see the last few years have shaped up to be very strong, but it also looks like the future for Nvidia could be starting, and that is most certainly what Wall Street themselves believe. Then we move on to the balance sheet, where we've already highlighted the very strong effect of this company due to the net debt to EBITDA being zero. But as we'll highlight, cash versus total debt for that health check, it's been increasing over the longer term. Again, pretty much in line with revenue, 4.6 billion in 2015, 39 billion in the latest quarter. And as we always like to highlight, any one number here isn't going to tell you anything, which is why we compare it to their total debt numerically and directionally. So when we look at their total debt from a graphical format, that has also increased over the longer term, 1.4 billion in January 2015, 10.2 in the latest quarter. As we saw, their cash is far superior, and that is supported by what we mentioned earlier. It won't take Nvidia one day to pay off all of their debt net of cash on hand. Now, we'll also just flag the cash from operations that this company does generate, and as we can see, again, pretty much following their top line revenue, they generated 906 million of cash from their operations 10 years ago, 28.1 billion just in that more recent year, and that is why we can see they are doing a lot of share buybacks, and they do have a large cash balance. In fact, we did also get that 150% dividend increase in May this year. Now we're going to jump into the valuation. Now bear in mind they get a D- because this is comparing it to the sector median, not just the valuation. We'll cover other aspects as well, but we can see on a non-GAAP basis, forward looking 46, sector around 25. So if you're buying this company as of today's day, you are paying an 81% premium to the overall sector. Is it worth a premium, and is it worth that much of a premium? Again, things to consider, but we can note here pretty much whatever metric you do use in the valuation for this company, it is trading at a fairly high premium. Now we take a look at their growth, A+. So look, we can understand it does deserve the premium. 152% growth year on year, sector at 4. Moving forwards, 93, sector at 6. And then when we take a look at another favorite metric of ours, the earnings per share growth over the next 3 to 5 years, anticipated 38%, as we can see, the sector at 15.4. We then finally look at the profitability, again reinforcing the premium aspect is warranted. A+, gross margin 76, sector median 51, bottom line 56, and we can see here sector at 4. Now the final thing we have already covered, but we will show you again, is their cash from operations are very, very high. In fact, this is on a trailing 12-month, 59 billion with the sector at 97 million. So a quick conclusion for this part of the analysis, we have that one strong buy from Wall Street, and we will say Seek Alpha and Quant are both sitting on the hold/buy with a valuation of D-, growth A+, profitability A+, and then we get to two final things before we do look at our valuation, and we want to compare their performance against others in the sector. We have Taiwan Semiconductors, Broadcom, AMD, massive companies which have also performed fairly well. Over the last year though, no one comes close. Nvidia up 187%, but this does highlight the majority of companies in this industry have performed very strongly. Over the last 5 years, Nvidia up 2,500%, no company coming anywhere near. And over the last 10, again, the same conclusion to be had. All we want to reinforce in this part of the episode is that remember that past performance should not be a guarantee of the future. They could perform a lot worse, but look, at the same time, they could perform even better. Just something to bear in mind. And then we'll highlight, although I'm sure you know the answer, the performance against the S&P. Over the last 5 years, outperformance. Over the last 10, again, severe outperformance, but it's just something we do like to remind you to consider when looking at companies. Now let's jump into the intrinsic value. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now we got to $140 through the DCF model, and we have here the free cash flow year on year. Over the last 10 years, they've been growing at 94%. Over the last 5 years, 135%. And we've gone very conservatively at 30%. Now, we do have a low, medium, and high here that we will get to shortly, but based on the 30% with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, our intrinsic value, which right now indicates to us there's 2% upside, so not actually far off its fair value. Now remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers where it is for Nvidia or any others. Full transparency though, we will show you at the 25% rate, this will get to $101, meaning downside of 27. At 35%, this will take you to 193, indicating 40% upside, and we do have this 42% from Bloomberg, as that is what they anticipated last year, that the growth of this market will be on a 10-year basis. And by using this 42%, what we can note is that the share price will be sitting around $300, which indicates more than a double from today's price at 115%. Nonetheless, we're going to take through the 30%, and another thing we want to mention, this is fairly conservative given the free cash flow we have here at $35 billion for the next full year is already lower than what we can see just in the more recent quarter. As we can see here, just year to date, this is sitting around $45 billion, so we do believe this is in fact very conservative today. So taking our intrinsic value, we always like to add a margin of safety, and we start at 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, in today's episode, we'll buy at $126, but what it goes to show us, in fact, you don't even get a 5% MOS with this company just yet. We believe it is trading around its fair value. Now, Wall Street, on the other hand, believe the opposite. They see just over the next year, this will go to $175. They see upside of 27%. For those that are interested though, as we said, 10% MOS at 126, at 15, 119, at 20, around 112, and at 25, around 105. So trading at fair value, Wall Street though, they see upside of 27%. Is this one you are looking to buy, maybe one you're looking to hold, or in fact considering selling? As always, give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We are dropping December's spreadsheet over the next few days, as well as the free article on Monday. And come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.